Today we'll be looking into the 4 distinct levels of retirement wealth in Canada and help you understand exactly where you stand. One of the biggest misconceptions among Canadian retirees is thinking that they're in a lower wealth bracket than they actually are. And this misunderstanding often leads to unnecessary stress and overly conservative retirement plans. Over our years working with Canadian retirees, we've identified clear patterns that separate the 4 distinct levels of retirement wealth. That's exactly why we're making this video for you today, to show you these 4 wealth levels and help you understand where you truly sit in the Canadian retirement wealth scale. Let's get right into it.
Now let's start with the first level of wealth, considered the basic retirement. That level of wealth would be retirement savings between the range of $250,000 and $500,000. Whether that is a combination of RRSP, TFSA, open account, these are all the accounts that you will utilize to supplement your other income sources in retirement. Now, the income that one could expect to receive from this level of wealth would be between $10,000 and $20,000 a year, if we're using the 4% retirement withdrawal rule. Now, obviously that would be added on top of your other income sources, whether it be CPP, old age security, and if you're lucky enough to have a defined benefit plan from your employer. Again, this income, in addition to those other guaranteed sources of income, are what's going to provide you with your income to live the desired lifestyle you want. If this income isn't enough, then you'll have to look to reduce expenses or find some way to increase the value so that the income level can increase. Now, if the level of income that you're receiving at this wealth level doesn't support your living expenses, well, then you need to be rethinking how your investments are allocated. In order to receive more income, you need to receive a higher rate of return or at least be able to provide more income from a larger balance.
So the next category is going to be the comfortable retirement, and that's for Canadians that have about $500,000 to $1.5 million in investable assets when it comes time to retire. So for this level of wealth, we're probably obviously going to get into the RSPs. So you're probably higher income earners that have been putting money away into RSPs to kind of reduce some taxes during their working years. And because there's such a influx now of assets for retirement, there's probably going to be some money in tax-free savings accounts, as well as some money in potentially non-registered funds as well for the retirees. The core retirement problems that people at this wealth level are going to be facing is primarily trying to reduce the amount of tax that they have to pay in order to supplement their retirement income. Carla, you already mentioned the level prior is going to get about $10,000 to $20,000 of additional income on top of Canada Pension and Old Age Security. Using the 4% rule here, you're probably around the $20,000 to $60,000 per year of additional income. Now, if all that income is going to come in the form of RSPs, you're going to lose a lot of that to taxation when it comes time in April. So what we should be focusing on here is if you do have TFSAs, open account, as well as RSPs, what's the best place to take it from in order to keep that tax at a low level, therefore prolonging that retirement benefit. At this wealth level, retirement planning is going to be absolutely crucial because you're in a perfect sweet spot, I think, that if you want to be able to leave behind a estate or leave behind something within the retirement, creating a plan is going to allow you to identify what's the amount that you're going to need on a regular basis. The amount that gets taken from the portfolio on a regular basis is going to have a big impact as to what is left behind for the estate. So creating that plan is going to be able to leave something behind. For example, when we speak with our clients, we always try to get a good understanding of what their goals are. And I'd say for a majority of our clients, it's going to be leaving behind some degree of legacy or estate to their next generation. So something that we've often done is identifying, okay, well, what is your main objective? If that is leaving behind something through the estate, is developing the withdrawal strategy over the course of their retirement that's going to, be able to cover their needs and expenses. That's the first and foremost. But B, also be able to leave behind something that's going to benefit their children, maybe even give them the opportunity to gift as they get closer into their retirement years.
Now, we can only cover what you should do at this wealth level in so much detail here today. But since everyone's retirement situation is unique, we want to make sure you don't leave this video without taking action because you don't know where to start. That's why we want to offer you a complimentary call, where we'll answer all your questions and help you plan for a successful retirement. Click the link below to get started right away. Now, the next level of retirement wealth would be the affluent retirement, and that would be a wealth range of $1.5 million to approximately $4 million. Now, typically, if you've accumulated this level of wealth for your retirement, you've got a number of different assets. So you have likely maximized your RRSP, maximized your tax-free savings account, have some money left over in a non-registered account, but also may have a rental property or a secondary property that you've been able to build equity in. When it comes to generating income, now you have options. You can be generating income from very low tax sources and managing your tax bill by moving some money from registered accounts to non-registered accounts. Now, one thing to consider at this level, if we're talking about the 4% withdrawal rate, that would put your income within the range of $60,000 to $160,000. If you are receiving your government benefits, that's definitely putting your income above the OAS clawback threshold. Now you are losing some of your income sources because the other income sources are putting you in a position to have significant retirement income. So tax planning is crucial at this stage in retirement wealth. One example that I can give you about a client with this level of wealth and helping with tax planning strategies is looking to liquidate their secondary property. Now, this was a vacation property that they were looking to gift to their children. And what we needed to consider was the increase to that capital gains inclusion rate that happened earlier this year, where any capital gain above $250,000, a higher inclusion rate was going to be applied to that capital gain. After speaking with the client and running several different scenarios of what the tax bill would look like once we liquidated the property, doing it later where the income had dropped, even though there was an increase to the capital gains inclusion rate, still made sense for their situation.
Now, finally, that leads us to our last level of wealth, and that is the high net worth individual who has over $4 million plus in retirement. So using the 4% withdrawal rate rule, this level of income would be over $160,000 per year for the household. So now that you've entered into the high net worth retirement level, income probably won't be an issue. What is going to be an issue that needs to be focused on, similar to what Carlo was mentioning previously, we're going to focus on taxation, but then also on the estate and leaving behind a legacy. Now, for some high net worth individuals that are at this level of retirement, one thing that becomes very important could potentially be gifting to children, leaving behind a legacy that way while they're currently living, if it does allow for it based on their lifestyle. Another option that does become very important could potentially be life insurance or utilizing an insurance policy in order to pass on money through the estate. And we talked about it previously where one of the goals would be reducing the amount of taxes you pay, but then also leaving behind a pretty good legacy. One of the options that we've utilized for some of our clients could potentially be a universal life or a whole life insurance policy where you take money that's from a taxable source in an open account, let's say, and put it into something that would be tax-free with some degree of tax-free growth in a universal life or whole life policy. Now, everyone's going to have different goals and expectations when they do get to this degree of wealth. So it might be a good option for some, and what's a good option for some may not be a good option for others, but it's definitely an option that's out there for a lot of high net worth individuals.
I think what we can take away from discussing the different levels of wealth is a plan needs to be put in place.
Absolutely.
Regardless of where you stand, regardless of what your end goals are, having that plan in place that is customized to each individual is important so you can try to achieve those goals and do what you can now to achieve those goals.
Now that you know the 4 distinct levels of retirement wealth in Canada, you need to understand one thing. These wealth tiers are just the starting point for understanding when you can retire. Through analyzing thousands of Canadians' retirement portfolios, we regularly see clients time their retirement far earlier than the right strategies in place. What's fascinating is that the difference between levels often has less to do with income and more to do with strategic financial decisions. Between tax optimization, investment efficiency, and government benefit maximization, we found that most Canadians have far more potential for wealth building than they realize. If you want us to analyze your current retirement position and show you how to move up to the next wealth level, click the first link in the description and book a complimentary call. We'll see you in the next one.